Hi, and welcome to topic 5, ACFI2080. In this topic, we look at mergers and acquisitions. This is part 1, so we're introducing the issues surrounding M&A transactions. The learning objective for this topic includes to understand different types of M&As, evaluate suggested reasons for takeovers or mergers, explain how to estimate the gains and costs of a takeover, explain the main differences between cash and share exchange takeovers. So here we're looking at different types of payment in an M&A transaction. We finally evaluate empirical findings of shareholder gains and losses following an M&A transaction. The lecture outline for part 1 includes firstly introduction to mergers and acquisitions, second the reasons to takeovers, third, economic evaluation of takeovers, and finally, the returns to shareholders. The required readings for this topic is chapter 19 of the Pearson textbook. So what do we mean by a merger or acquisition transaction? So when we have a takeover, this is when we have a person or a company purchasing shares of another company. So after the transaction, there is a transfer of ownership from a group of shareholders to one dominant group of shareholders or one particular company. M&A transactions are large in size and they attract large interest from the public and regulators. M&A activities can be seen as investment projects. So buying a new company can be seen as an investment project in the sense that we acquire all the future cash flows coming out of that company. The only difference here is M&A transactions are more complex in the sense that number one, the ownership that we get might not be 100%, whereas if we buy like a building and we establish a business on that building, the ownership to the business is normally 100%. Second, M&A transactions are more regulated compared to normal investment. This is because there are a lot of issues with shareholders' protection and also the level of competitiveness in an industry. So typically an outcome of a takeover transaction or an M&A transaction is that the target ceases to exist, so they are merged into the parent company and they are operated as part of the business. The second outcome could be that the target company would become a subsidiary of the parent company, of the acquiring company, but they are run separately. So some people view M&A transactions as being part of the market for corporate control. And what do we mean by that, right? So recalling from a previous discussion that the share markets are the markets to exchange for ownership, right? To exchange ownership. So shares are basically just certificate of ownership. So if you have 10% of the shares in PHP, that means you have 10% ownership or the voting rights in PHP, right? So if we think about M&A transactions as competition for corporate control, the view here is that different teams of managers or different investors believe that they are better compared to the existing management in terms of managing the assets of the firm. So they make better management decisions. So as a result, they want to acquire a different company, replace the management, and manage the assets more effectively so that the shareholder value would increase under the new management. So as we mentioned before, M&A activities could be also viewed as just another investment, right? So it's just like buying a new production line. However, there are reasons that M&As are distinct from other investments. Number one is that M&As are controversial and there has been heated public debate about whether takeover activity is beneficial to shareholders and the economy. So Takeovers are controversial in the sense that it relates to the issue of conflict of interest between the shareholders and the managers. So if we think about the shareholders in the target company, so after an M&A transaction, normally the management in the target company would be replaced by a new management, because the argument here is that we believe that the target's management is ineffective or inefficient, and therefore it's value enhancing to replace them by a new management, right? So that means that replacing management in the target company is better for shareholders. However, the managers would be sacked, right? So the issue here is, do we expect managers in target companies to act in the interests of the shareholders if they believe that if it's likely that they will be sacked afterwards? Also, when we look at we'll look later on at shareholders' gains and losses in the target company and the acquiring company. And normally, at least in the short run, we find that the acquiring company shareholders tend to make losses after an M&A transaction. So that suggests that normally with an M&A transaction, the acquiring company tend to overpay. So overall, it's not a good investment. Second, the NPV of a takeover can be difficult to estimate. So with a normal investment, we project the future cash flows. We use the firm's cost of capital, or we modify the firm's cost of capital according to the riskiness of the investment, right? With an M&A transaction, the benefit of an M&A transaction comes from the synergy benefits by combining assets into different companies. So synergy benefits are intangible, and therefore sometimes it's a bit harder to evaluate. The third reason is that a takeover may give rise to complex legal, accounting, and tax questions. So, for example, the issue with antitrust. So, when we allow two companies in the same industry to merge, the question here is, how does that affect the competitiveness of the whole industry? Finally, unlike normal direct investments, in an M&A transaction, the target company might have defensive tactics that make it harder for the acquiring company to buy the firm, right? So we mentioned before that there's an agency conflict between the target company's management and the shareholders. So sometimes the management in the target company might implement takeover defenses that make it harder for any company to buy the target company, right? Also, the investment in another company might be intervened by other companies that also want to buy the target company. So, as an overview of corporate control activities, what do we mean by corporate control? So, corporate control are any activities that affect the monitoring, the supervision, and direction of a corporation. Takeover is part of the corporate control market. So a takeover is a transaction where we have a transfer of control from one group to another. So besides takeover or acquisitions, we have other forms of corporate control as well. So for example, we have consolidation of voting power. So we have a big shareholder buying up the shares of the little shareholders, and they become the majority shareholder. So their voting would therefore be the most powerful. Divestitures is the opposite to acquisitions. So this is when a company sell some of their existing business. Spin-off is also quite similar to divestitures in the sense that a big company sells off some of their business lines. So if we define mergers and acquisitions in terms of who or which company the acquiring company is buying, then we have three categories. we have horizontal takeovers. This is when companies in the same industry buy each other, right? So we have two banks buying each other in 2008, right? So the key issue with horizontal takeovers is, as you can see, the level of competitiveness in the industry. Vertical takeovers is when you have a company that is buying either a supplier or a customer, right? That buys goods and services by the acquiring company. So an example here is when we have CapCharge. This is a provider of a payment service for the taxi industry. And CapCharge bought Yellow Cabs. So this is a company that provides taxi services. So one argument for vertical mergers is, say for example, you have a technology, you have a supplier that provides one of the most technology for your products, and you don't want your competitors to have a hold on the technology. So what you can do is you can internalize the production of that technology by buying the supplier. The third category is a conglomerate takeover. This is when so we have a big company, for example, go and buy business in unrelated industries, right? So conglomerate takeovers tend to happen when we have a big company with a lot of capital base, right? Like Wesfarmers. Or in Japan, we see a lot of cases where we have an industry conglomerate that is comprised of a bank. So the bank provides capital for individual businesses within the conglomerate, right? If we define M&As in terms of the outcome of the transaction, then we have these following categories. We have a statutory merger. This is when an acquiring company buys a target company, and after that the target ceases to exist, right? So no remaining trace of the target as a separate entity after the merger. We have a subsidiary merger. This is when after the merger, the target is run as a subsidiary of the acquirer. We have a reverse triangle merger. This is when the the acquiring company buys a subsidiary of the target company. We have a consolidation where after the merger, two companies, the acquiring company and the target company, cease to exist, and they combine to make an entirely different company. If we define an M&A transaction in terms of how it is offered, then we have a tender offer. This is when a company, like an acquiring company, announces publicly that they want to buy the shares from shareholders on the market, right, at a specified price and time. With a hostile takeover, this is normally when the management of the target company does not approve or does not endorse the takeover, but the acquiring firm still goes ahead, right? So they will still make a direct offer into the share market, public offer into the share market to buy shares, even after the management in the target company refuses to endorse the M&A transaction. We have mergers of equals, where two companies of the same size merge together, and these are normally friendly mergers. So let's look at the size of M&A transactions in the past. So what we have here is we're looking at the volume or the size of M&A transactions in the US throughout from 1984 to 2010. So what we observe here is that the size of M&A transactions, the total size of M&A transactions tend to increase over time, and they tend to follow cycles, right? So what we see here from 1991 to 2000 is a steep increase, right, in M&A activities. Then from 2001 to 2003, there's a very steep decline. So these periods coincide with the dot-com bubble. So as you can see, in the few years before the dot-com bubbles, M&A activities increased quite a lot, right? When the bubble burst in 2001, M&A transactions decline dramatically, right? So what's the explanation here? So before the dot-com bubbles, people were really hype about tech stocks, and the M&A transactions here reflects the acquisitions happening in the technology industry, right? So after the bubble bursts, there's nothing happening anymore. So this shows us that the M&A transactions, the peak of the M&A transactions around this period here is due to the activities in the technology industry. Right. We see the same pattern in the next few years. So from 2004 onwards, the market for M&A was doing really well, so the market was really growing. Then after the GFC, we once again saw a reduction, right? A dramatic reduction in M&A transactions. So what does it tell us about market efficiency? So at least from the graph, we see that the market tends to, there's a period of building up before any crisis, right? So people were really overly optimistic before the bubble. Right. Then when things went wrong, they just keep selling, right? We then look at the M&A activities in Australia. So in this graph, we're looking at the number of transactions. So we're comparing the number of M&A transactions with private placements on the left-hand side, and on the right-hand side we have the size of M&A transactions relative to private placements. So by number, the number of M&A transactions are quite comparable to the number of private placements over time. However, when we look at the size of the M&A activity compared to private placements, we will see that M&A activities are very large compared to private placements. Right. We then look at the New Zealand market. So in New Zealand, the picture is quite consistent in terms of the number of transactions and the size of the transactions, right? So in New Zealand, the M&A activities outweigh private placements in both numbers and in terms of the value. Right. We then look at cross-border transactions involving US companies, so either US acquirers or US targets, right? And what do we see here? We see that US firms like to acquire companies in the UK, in Canada, in Australia, not so much in Germany, China, France, India. Japan is a bit sizable as well. In terms of the targets, US firms tend to be targets for Canadian firms. UK and Japan and Germany are also big buyers of US firms, right? And the rest of the companies are quite small relative to these companies. We then look at the size of M&A transactions across regions, right? So we're looking at 3 regions here, either the USA, Asia, or the Europe, right? And the time frame that we're looking at is from 1998 to 2003. So what this graph shows us is it shows us the size of M&A activity where the acquirer is from a certain region and the target is from some other region, right? So the big bar over here, the big purple bar here, is when we have the acquirer and the target both coming from the US. This bar over here is when we have an Asian acquirer and an Asian target, right? Similarly, this bar here is when we have a European acquirer and a European target, right? So comparing the size of these bars to the other bars in the graph, we can conclude that from 1998 to 2003, most of the M&A activities happen within the region, right? So US companies tend to buy US firms, European companies tend to buy European firms, so on and so forth, right? The only exception here is we have the little bar here, where we have European companies doing a bit of M&A activity in the US, right? So in this graph, we are looking at, once again, M&A activities by region, but this time from 2004 to 2009. So this picture is consistent with what we saw before, where we see that a lot of M&A activities happen within the region itself, right? So M&A activities tend to be graphically concentrated within the region. The only difference here is we see an increase in M&A activities across all three different markets. So despite globalization, for some reason we still see acquirers preferring to acquire firms within their region only, right? So this is what we call a home bias. In the next graph, we're looking at foreign acquisition of Australian targets in 2011. So what we have here is we have companies, Australian companies, acquired by either the US, a UK firm, a Chinese firm in the Cayman Islands, Japanese firm, Thailand, and firms from other regions, right? The orange bar shows us the number of acquisitions by, for example, US acquirers, and the blue bar shows us the value, the total value of these M&A transactions coming from the USA, for example. So, judging by size, the two biggest investors, foreign investors in Australia, are UK firms and Japanese firms, right? Followed by Chinese firms and US firms. For other regions, we do see a lot of activities in these regions, but the size of these activities are not too much. Right. Also, if we look at the individual M&A transactions over the last few years, these are the 15 largest takeover transactions by size, right, in the past. So the first one being Vodafone buying Mainsmain in Germany, and the value is $202.8 billion US dollars in 2000. So this slide shows, this slide illustrates the size of M&A transactions, and as you can see, they tend to be quite large, right? We then look at an issue in M&A transactions where we observe that over the past, we tend to see M&A activities to follow some sort of cycles, right? So the reason why we see those waves or those cycles is not fully understood yet, but what we do know is that they tend to follow share prices, right? So one explanation here is when share prices increase, that means that the prices of goods or services increase as well, and therefore firms need to increase their productive capacity, right? So one way to do that is to buy existing assets in different companies. Right? A similar explanation is that M&A activities follow the economy, right? So they are driven by fundamental economic factors. So if the economy is doing well, we see a lot of M&A transactions and vice versa. So in the next few slides, we'll be looking at different reasons for mergers and acquisitions. In particular, we emphasize on synergy. So we define what it means by synergy benefits, and why is it the most recently cited reasons for M&A activities, right? It might not be the true reason, but it's one of the mostly cited reason for an M&A activity. So in this study, what people did was that they went out and surveyed CEOs and CFOs of the reasons why they do M&A activities, right? And out of all the people that responded, these are the top reasons that they say they went and do M&A activities for. So the top reason by voting is synergy. The second reason being diversification, right? So if you buy assets in different industries, it might potentially make your cash flows, the aggregate cash flows, less volatile because of the diversification. Restructuring. Buying undervalued firms using excess cash flows. So we have no other investment to do, so we just go and buy another company, right? So on and so forth, right? So the top reason is always synergy benefits. So what do we mean by synergies, right? So what do we mean by synergy? Synergy is defined as the extra gain that we get from combining the assets of two different companies, right? So this is possible if assets in two different companies are complementary, and therefore by combining the two different asset bases, we are able to, for example, make a third product or something, or infiltrate a different market niche. Right. So by definition, if there is synergy, then we would expect this. We would expect that the value of the combined company to be higher than the sum of two independent companies, right? So the value here comes from managing the assets of the two companies together. So where does synergy come from? The first argument is that we get synergy benefits from managing the assets of the target company more efficiently. So one argument of why the acquiring company wants to buy the target company is because they believe that the current management in the target company is not efficient, right? So they're not maximizing the utility of the target's assets. So by combining or by acquiring target assets, we believe that we can manage the company using their assets more efficiently, right? Complementary assets. This is when we have companies that producing different products, and the products in one company might be complementary to the products in the other, so that when we combine two together, the production can be resourced at lower costs. Cost reduction. So something like, for example, economies of scale, right? So if two companies require the same input, the same supplies, so by combining them together, we might have a better bargaining power, and therefore we might be able to get cheaper price from our suppliers. Other reasons include, firstly, the target company is undervalued. So by buying an undervalued firm, we're making a good investment in the sense that when the market corrects itself later on, we earn the difference. Right? Increased market power. So in this case, in particular with horizontal M&As, when we combine two competitors, two market players together, the market power of the combined company can be larger, but this is subject to approval from ASIC, right? Because it relates to the competitiveness of the industry. Diversification, so we combine cash flows from different industries, and overall, therefore, we reduce the volatility of the overall cash flows. Okay. So the idea of diversification is we combine uncorrelated cash flows or less than perfectly correlated cash flows, and by doing so, we reduce the total risk of the cash flows. So what are the specific benefits of diversification? We have co-insurance of debt. So each individual company borrow from different lenders. So when we have one company failing to generate enough cash flow to pay their debt in a certain year, we could use the cash flows generated from the business of another company to pay for the debt expenses, right? So in that sense, we reduce the total distress risk of the company altogether. By combining different companies, we create what is called an internal capital market. So similar to the previous idea, when we have different businesses, we have different cash flows. So if one division needs cash to make investments, we could use the excess cash flows from another business to fund the first division internally. So by funding the different divisions internally, we save transaction costs. Managerial risk reduction. So managers acquire other companies to reduce the volatility of the combined company's earnings, and therefore reducing the risk that they will be fined. Right? Other benefits of synergies include excess liquidity and free cash flows. For example, if a company has a lot of cash flows or it's very liquid, it's normally targeted by other companies that have a lot of investment opportunities but has no cash, right? So this is once again similar to the diversification idea. Tax benefits. So for example, we have a mature company buying a young startup firm. So with the young startup firms, in the first few years they make losses, and therefore they have accumulated a lot of tax credits, right? So to reduce the total tax payment, the mature company can buy this young startup firm to take advantage of the tax credits. Also, different companies might buy other companies in the hope that the earnings per share might increase, right? But this increase might be mechanical, as we will show in the next slide. So even though there's no new value created, we can still have an increase in EPS or earnings per share. So as an example, this is an example from the textbook. So we have a case where we want to combine company A and company T, company A being the acquirer, company T being the target, right? So assuming that we know beforehand that there will be no economic benefits when combining these two companies, right? So there's no synergy, meaning that the sum of the value of the two companies, independent companies, would be the same as the value of the combined company. Right? So in this case, if A acquires T by issuing one of its shares worth $10 for every 2 T shares, also worth a total of $10, what is the effect of the takeover on the earnings per share and the value of company A? Right. So we mentioned before that we assume right at the start that there is no economic benefits, and therefore the earnings of the combined company will simply just be the sum of the individual company's earnings, right? To finance for the takeover, Company A issues 50,000 shares, and therefore there will be 250,000 shares outstanding for Company A. The earnings per share for the combined company is simply just the total earnings divided by the number of shares, right? So in this case, we have an immediate increase in the earnings per share of 20% without an increase in value, right? So this exercise shows us that the earnings per share might increase after an M&A transaction without necessarily an increase in the synergy benefits, right? Or an increase in the total firm value. Okay. So besides the generally cited reasons, value maximizing reasons for M&As, there are other non-value maximizing reasons for doing M&A transactions as well. So recalling from previously, we discussed that M&A transactions suffer from the inherent agency issue between managers and the shareholders, and in this case, we're looking at the agency in the acquiring firm, right? So, managerial theory of mergers is based on the premise that managers' compensation is often tied to the company size, right? So, the larger the firm size, the higher the compensation of the managers. So, it gives them an incentive, therefore, to keep expanding the company without necessarily increasing the value to shareholders. So, this is quite consistent with the free cash flow hypothesis, where mergers and acquisitions are ways that managers use excess cash flows without increasing the value of the firm, right? So without positive NPV values. We also have the hubris theory, where in this case managers are overconfident, so they overestimate their ability to manage the target company's assets, right? So they overestimate the value of the target and therefore pay for the target shares higher than they should pay. Finally, we look at the agency cost of overvalued equity, and this is quite an interesting hypothesis. So what it says is that when a company is overvalued, this is when the shareholders have very high expectation, right, for the company's performance. So in this case, managers are under pressure to keep maintaining the illusion that the company is doing very well. So what they can do is therefore to pursue short-term actions that might be short-term value-enhancing actions that might actually hurt the firm in the long term, right? So they might buy a lot of companies at the moment. But in the long run, if these companies are not positive NPV projects, the shareholders' value would decrease in the future. So overall, given that a takeover transaction or an M&A transaction is a transfer of control from the current shareholders to new shareholders, and potentially there will be a replacement of management, right? So when a new firm acquires a company's a target firm's assets, they tend to replace management as well. So given the potential risk of being taken over and being replaced, managers in target companies therefore have an incentive to manage their assets efficiently so that they will not be replaced. So mergers and acquisitions therefore also discipline managers of target company. Also, as we mentioned before, takeovers can extract synergies, right? So when we have two companies merging together, the value of the total company and therefore the total shareholder value would increase because of economies of scale, for example, or complementary assets. So in the first case, when we have a replacement of management, the value comes from the change in control, whereas in the second case, the value comes from things like economies of scale or by managing the assets more efficiently. We then look at the methods of payment in an M&A transaction. So in an M&A transaction, the acquiring firm or the bidding firm, they buy shares from the shareholders in the target firm. Right? So the shareholders in the target firm would either get cash payments or they could get shares in the bidding companies in exchange. Right? So there are two methods of payments, either a shares payments or a cash payment or something in between. So in this section, we'll be looking at how to price an M&A transaction. So from an acquiring firm's point of view, say suppose we spot a good company that we want to acquire. The next question is therefore how much should we pay for the shares of the target company, right? So how much should we pay the shareholders? Actually, there are two things that we should consider. The first one being the method of payment. So if we were to pay cash, if it's a cash transaction, then how much cash should we pay? Alternatively, if we were to issue shares in exchange for the target company's shares, then how many shares should we give up? How much control should we give up in the combined company? Right. So if we think about the gain, if we think about an M&A transaction as a cost-benefit analysis, then the gain from the transaction comes from the synergy benefits, right, for the acquiring firm shareholders. So the synergy benefit, as we defined before, is the extra value that we create by combining the acquiring firm and the target firm. So to quantify the synergy benefits, it will be the difference between the value of the combined firm and the sum of the individual firms, right? The acquiring firm and the target firm. In terms of the cost, now assuming that we use cash, right? So this transaction is settled by cash, we don't pay shares, then the net cost of the transaction would be how much we pay minus how much we acquire, right? So this is the value of the target firm. This is how much in total we pay for the target shareholders. So a way to think about the cost is therefore the premium that we pay over and above the value of the target firm as an independent entity. Right? So therefore, if we think about the M&A transaction as an investment, this is a positive NPV investment if our gain is higher than our cost, right? So if this difference is positive, then this is a value enhancing investment, right? So substituting cash minus VT into net cost, we have this equation over here. So we would only buy a firm if the gain minus the cash, the payment that we pay, plus the value of the target firm is positive. Right? So from this equation, we know that we would only pay the maximum price that we pay the target or the cash here. So we want to find out how much should we pay for the target shares, right? So the maximum price that we would pay would be the gain, the synergy benefit, plus the value of the target firm, right? So this equation also implies that the more we pay, the more cash we give up, the less that we retain, right? The less, as the acquiring shareholders, the less we retain in terms of the synergy benefits. So there are two components in this equation, the synergy gain and the target firm's value, right? So to estimate the firm value, the target firm value, we rely on market efficiency, right? So if the market is efficient, then the best estimate of the target firm value would be the market capitalization of the target company. So this bit is easy, right? Estimating the synergy gain is a bit more tricky. So with the synergy gain, what's important is the difference, right? The difference between the value of the combined firm and the total sum of the independent firms. So what we care about here is the incremental cash flows that are generated by combining the assets of the two companies. So in terms of the incremental cash flows, the examples of incremental cash inflows include the extra sales revenue and the proceeds from selling off some unnecessary assets, right? The incremental cash outflows include things like operating costs, taxes, additional taxes paid, and necessary capital investments that we need to expense to upgrade existing assets. So, as we mentioned before, in the payment equation, so our payment or our cash is equal to gain plus VT. So the more we pay to the target shareholders, the less we retain as the acquiring shareholders, right? So the amount of cash determines the total gain that we the total value divided between the two sets of shareholders. So the more we pay to the target shareholders, the less we retain as acquiring shareholders. So when we look at the equation again, so cash is equal to gain plus VT, right? So in deciding how much we offer to the target shareholders, we have to be careful because if the takeover news is announced to the market, then the market prices therefore might already incorporated the value of the M&A transaction. And therefore it's necessary to make sure that we don't double pay, right? So we don't double pay the target shareholders by paying higher than the pre-M&A announcement prices. Right. So to prevent news from leaking into the market, and therefore prices of the target firm to increase, it's important that we don't we make sure that the event is confidential. Okay. So we look at cash exchange before. Now, if we have a share exchange takeover, then how do we determine how many shares that we exchange to the target shareholders? Right. So if we exchange shares instead of cash, then the net cost for us in this case would be the proportion of shares in a new company that we give to the target shareholders and the value of target shareholders, right? Okay. We also have different ways to evaluate or to price an M&A transaction. The first one being valuation based on earnings. So we might use publicly available PE ratios to estimate the future target earnings. We then have valuation based on assets. So we look at the current asset, the current balance sheet of the target firm, and we work out the value of the market value of the assets, the market value of the equity of the target firm, by deducting liabilities from the market value of the assets. Comparables. So in this case, we estimate the market value of the target by not relying on the share value of the target itself, but we compare the values of the target with comparable companies. Precedent transactions. So in this case, we decide how much we pay for the acquisition based on previous transactions. in this part, we look at the returns to shareholders in M&A transactions. So we look at empirical studies that track M&A transactions and compare the target returns to the acquired returns, right? So overall, for target shareholders, we find that for target shareholders, they always get positive returns after an M&A transaction. For acquired returns, the result is the opposite, right? So overall, the empirical evidence is mixed, but at least in the short term, we find that target shareholders suffer losses after M&A transaction. We also look at the combined returns. So we find that overall, the combined returns is positive, so it's between 2 and 5%. But as we mentioned before, this is probably attributed to target shareholder returns, not the acquired shareholder returns. Also, the shareholder returns tend to depend on the method of payment. So for target shareholders, normally the return is higher in cash transaction compared to share transaction. So some example studies include this study here that I show on the slide. So what this study shows is it shows the abnormal returns, short-term abnormal return, right? So this is only a 2-day window for target and bidders across 3 different periods, right? And the companies here are US companies. So we can see here consistently for the target firm, they earn substantially large positive returns after M&A transaction. So 2 days, within 2 days after an M&A transaction, target firm shareholders earn substantially. But when we look at the bidder firm, their shareholders are not doing as well, right? So most of the cases they make losses, or sometimes if they make returns, the returns are really negligible. So the combined returns is around 2% to 5%. And if you compare these two groups here, you'll see that the positive combined returns tend to come from the target shareholders. So in terms of the distribution of 2-day target abnormal returns, overall we see that for the target firms, positive returns tend to dominate, right? So most of the time they earn positive returns. So in this slide, we're looking at the distribution of mergers and acquisitions by way of payment, right? So we have 3 methods here. We have either an all cash payment, an all equity payment, or a mixed payment, right? So we don't know the proportion of cash and equity in here, but we know that the target shareholders are paid a little bit by cash and the remaining by shares, right, in the new company. So predominantly we see that cash exchanges or a little bit of cash or the mixed method is more preferred compared to shares, right, compared to share payments. So why is that the case? So one reason, as we see from before, that in the previous study, when we look at the bidder's shareholder returns after the M&A, we see that normally after the M&A transaction, the shares in the acquiring firm lose value, right? So therefore, for the target shareholders to accept these shares is actually a value destroying decision, right? So cash in this case is better because the shares in the acquiring firm would reduce in value in the future anyway. So if we condition the returns of the target and the bidder shareholders by way of the method of payment, then we have this distribution over here. So this column here shows the return of these 2 groups of shareholders in cash transactions, and these are all equity transactions, right? So we basically see the same picture as we saw before. So with the target shareholders, at least in the short run, they earn substantially high returns, right? So once the M&A transaction is announced, they earn, for the cash transactions, they earn 26% per annum. And for the stock transactions, they earn substantially less, but they're still 12%, which is a very healthy investment return. This is per year, by the way. For the bidding firm, the story is a bit more gloomy. So they earn negative returns, right? And it's even more negative under the all stock transactions. The combined 2-day returns is either positive but in small magnitude, or negative, right? So when we look at the transaction, the proportion of transactions where bidder shareholders earn positive returns, it's around 45% in the all cash transactions and 23% in the all stock transactions. Whereas for the target shareholders, most of the time they earn positive returns, right? So these results show us that M&A transactions are good ideas for target shareholders, but not so good for the acquiring shareholders, right? So this is consistent with not the value maximizing motives of M&A transactions, but it shows the opposite, right? It shows that maybe these transactions are overvalued or bad investments, and that's why the acquiring firm shareholders suffer afterwards. So this is more or less consistent with the agency argument for M&A. So in summary, in the first part of this topic, we introduce the concept of M&A transactions. We look at the size, so we give a bit of background information about the M&A market. We also explain that the M&A market is seen sometimes as the market for corporate control. So people try to acquire assets in different companies, acquire control in different companies so that they can make decisions, right? Because they believe that they manage the assets of the target firm better than the current management. We then look at the reasons behind mergers and acquisitions, and finally we look at the returns to shareholders, right, after an M&A transaction. So the picture here is normally for target shareholders, they earn quite a fair bit, but for the acquiring shareholders, they kind of lose after an M&A transaction.